Well, yep, you're right, guys. The title pretty much says it all. This week is lining up to be the week that basically just gets us all double wrecked. We got the combination of bank failings even more, in addition to the CPI release this week, in addition to the Fed just seemingly being bent completely on just destroying everything at all costs to get inflation down. I mean, is the Fed gonna just destroy the banking system altogether? And are we basically double screwed? Well, let's discuss that today, right after you gently tap that like button and consider subscribing to It's Super Easy to Do if you like the truth without the hype. And it looks like Tesla's finally pulling out of its slump here, guys. I may be a little bit early here on the call, so let's wait and see. But this could be the last weekend that the group is on sale for the Tesla dip sale, where you get 5 free courses. You get access to me anytime you want through my DMs. We got live Q&As. You can see my buy and sell alerts, my watch list with price targets. Basically, just so much. Just check out the pinned comment down there and see everything that's included with that. So let's talk about the banking crisis first, and then we'll move on over to the CPI release and what I'm planning to do personally through all this. So honestly, the freak out is just getting louder and louder about the Fed raking hikes and this banking crisis and everything else. I mean, remember, back in June, a lot of these same folks were the ones that were screaming, saying, we got to get, the Fed has to raise rates up to 10% to get rid of that 9% inflation that we have. You have to go to 10. And we came on this channel right here and we discussed it ad nauseum. I discussed it in my group. I discussed it everywhere I could that just simply wasn't true. And guess what? That was actually proven out right. We didn't get anywhere near 10% to see not only inflation starting to inflect down, but starting to inflect down and march down quite specifically, quite hard. Never got anywhere close to 10 in order for that to happen. But now everybody's screaming that the Fed's going too far, too much. They're going to crash the whole banking system altogether. Look, they're just creating bank failures everywhere, all over the place, because they just basically raised another quarter point. And they might raise another quarter point. This is just insanity. The Fed's out of control. As if when they were at 4%, SVB was going to be okay. But whenever they raised to 4.5, that was just too far, causing SVB to fail. Nothing to do with anything else that's going on. And right now, they're basically going from 4.75 to 5 or 5.25, depending upon how you want to calculate it there. It's just a step too far. If they just would have left it right at 4.5, everything would be fine. All these bad banks with bad management, poorly run banks, poorly managed managers, and basically bad asset pools, all these other mistakes that these banks made, those are just magically going to go away because you didn't raise it another quarter point like you needed to in order to stamp out inflation. That right now is the current narrative that's out there. So let me ask you guys a question right here. Why is it that while some of these banks, a handful of them, are failing and are really, really struggling, why is it on the other side some banks are having record profits after record profits after record profits? Why is that exactly? Why are we seeing that? I never understood where the narrative came from. I didn't put it out. I was saying the exact opposite, that I was buying banks like crazy whenever the banking sector got beat down because banks stand to make a lot of money whenever interest rates go up. That's been the historical performance of banks. Not like, and the narrative was at the time was basically, hey, guess what? Banks are going to have to increase their savings rate, but they're going to have all these low loan rates out here. And so, see, they're going to be negative because they're going to have to pay 4% in a savings account, but they're going to have to, they got all these 3% mortgages out there. So, of course, now they're losing money. And that's the dumbest thing I've ever heard in my life. That is not how banks manage interest rate risk. They have teams, hundreds of people, and in some of the bigger banks probably have thousands of people. That's all that they do is they buy and sell loans. They move the rates of their checkings and their savings and their money markets and all those sort of things to where the banks make more money. When the rate goes up, there's a bigger spread they can make between what they're getting in loans and what they're paying in savings. When the rates go down, that's when banks are hurt the worst because they don't have a margin to play with. But the ones that once the rates go up and they have some margin to play with, they just increase those margins and they start to print cash. Basically, the only way a bank doesn't make money during times like right now are poorly run banks who did not manage that interest rate risk, which of course was SVB. We saw that wide open. Everybody, that will be in MBA books, for decades into the future as to how to not run a bank. That's how bad that was. That's how embarrassing that was. And now you're seeing some other banks that took on excessive risk. They have some excessive exposure, and they have some banks that or some loans that are starting to roll over that are starting to go bad, and some other things like that. That is poorly managing your loan portfolio. This is not something that is indicative of the entire banking system. The entire banking system as a whole is printing money. The difference is we got some bad actors out there, and unfortunately, when interest rates raise, This is what happens, not just in the banking world, in all the other worlds too. All these bad startups that should have never started up, that should have never had $100 billion valuation or whatever the heck the ridiculous valuations were out there, and all these speculative EV companies. You can remember, I didn't understand a lot of the EV plays and a lot of the hype behind them and such, because it was like, what? Like, nobody's driving that around in the US. It's a US based company looking for the US market, and somehow we're going to ride around like a go-kart on the freeway or some other ridiculous looking thing like that. Like, there's no way. Like, there's not enough, there's going to be demand in certain cities and certain areas, and I think it absolutely has a purpose, but it's not a $100 billion company. But yet that's what they were trading for. Those are the multiples that were there on some of those companies. That happens in a low interest rate environment where everybody's just throwing money at every investment, trying to make it work. So guess what? Companies like that are exposed badly whenever interest rates go up. And guess what? They needed to. That's what happens. Zombie companies that hung around that should have died a long time ago hang around because they can continue to just get cheap debt in order to continue to operate. That's not good for the economy long term. We need those companies to go away so everybody can spend their money on better companies, innovating, creating better products, better services, better everything. So that way the bar is now higher. Now whoever comes in to fill that void, can actually fill it with something that is better and actually have a better company and actually have an investable asset for us to invest in.
But Luke, isn't this worse than the financial crisis?
Well, let me hit you guys with some reality and some actual facts behind this. During the financial crisis, basically from 2008 to 2012, we had 466 banks fail just here in the US. 466 banks. And then in the following 10 years after that, basically from today, go back 10 years since the financial crisis, once all those 466 had failed and all that was all over with, the US averages 7 bank failures a year every single year. That's the average, guys. I don't remember anyone screaming about crises every other year whenever we have 7 fail in a year. But here we are. I agree, we're ahead of the pace. We're at 4 right now. We're ahead of the pace of 7 for the year. But we're not in crazy territory, and we're definitely not anywhere close to 466. We had multiple years where there was hundreds of banks that went under. We're not anywhere near that. Not even close, and obviously I don't think we'll get close. So what, maybe we have a year where we have 10, 12 failures this year? I don't know. I've been saying from the start, I think we're going to have more. I think there's going to be, out of the thousands of banks out there, thousands of banks, there's going to be a handful of bad actors. But it's like I think right now we're sitting at like 1/100% not even 1%, 1/100% of banks have failed. That's it. So even if we doubled, cool, we're 2/100ths of it. I mean, you just go through the numbers and it's astronomically low in regards to banking failures. And oh, by the way, we average 7 every year. So let's see how the rest of this year plays out. Maybe it accelerates, maybe it doesn't. But for right now, to compare it to anything to 2008 to 2012, to basically say, oh my gosh, this is contagion, it's getting worse. And honestly, what if we don't end up even at 7 by the end of the year? That means it was an average year. Average year. So when I kind of think through all these sort of things and I kind of think, wait a second, what's going on right now? There's banks out there with record profits, record everything. Now, I'm not saying this is good. I'm not saying, everything is perfect. And I'm not saying it's not stressing certain businesses. But to basically lump this all in and have a freak out over the fact that, the Fed chairman continues to raise rates, which, by the way, people have been freaking out since June of last year that he was raising rates too far, too fast, and he was going to kill the economy. Think about that for a second. Think about where we were at. Nowhere near. Think about where inflation would be right now if they would have listened to the narrative that was out there on TV, on YouTube, and everywhere else and stopped back in June last year. What do you think inflation would be? Will we be getting down into these, almost into the 4s here? Or would we be seeing these new lows and new lows every single month that seem to be accelerating to the downside? I don't think so. I think we'd be in a very different scenario. Oh, and by the way, all this noise and all these people on TV at certain financial institutions and, investors and all these other folks calling for the Fed to lower rates and start cutting and you're gone too far and all these other things like that. Guess what happened in the 70s, which is exactly what we're trying to not repeat. That's exactly what the Fed did. As soon as inflation started inflecting down and they were, basically showing progress, significant progress, the Fed would then start cutting rates and inflation would come roaring right back. And then they'd be in the same yo-yo cycle of, oh, great, now we got to raise them up again. Now we got to go to back then. Basically, you had a lost decade with almost everything during the 70s, which from the start, the Fed Chair Powell and everybody else has said, we don't want to repeat of the 70s. We want the 80s. We want Volcker. This is all played out before. This is not new. Stamping out inflation by raising the rates to get it moving in the right direction, then cutting rates to make the investors happy and make everybody else happy is not the right move because you just end up yo-yoing for a decade. Because that's exactly what happened. It took Paul Volcker raising the rates to ridiculous levels, well above inflation, even as it started inflecting down, continue to hold it well above inflation until it was completely stamped out. That's exactly what I expect to happen here. But it is absolutely crazy to start asking for cuts right now or stop raising Fed. You're just hurting the banking system, which isn't true, or all these other things. Guess what? When you have these type of events, it's going to hurt a little bit. And we're not hurting like we were in the 80s. In the 80s, when Volcker did what he did, hey, unemployment shot up to 10%. It just came in. It's freaking low. It keeps going down. It's going the opposite direction. We had, huge declines in GDP. Now, we are seeing GDP finally decline, but that's coming off a red hot past 2 quarters. It finally declined down. It's still in the ones. We're still growing. Guess what? If we had a couple of shallow quarters of GDP going down like we had last year, that's not it's a recession technically, but that's all it is a technical recession. Last year was like the mildest recession in the history of recessions. Can you name one that was more mild than last year's? I don't know. We may get one mild this year. Who knows? But all I know is this, in terms of their plan, has worked just as effectively as Volcker's plan did in the 80s. And more importantly, they've managed to not break things completely underneath. Now, have some things broken? Yes. Have some of those things needed to break? Yes, absolutely. Is there going to be more things that break in the future? Yeah, I think you kind of have to in order to do this. But in order to stamp out inflation, you've got to break out these things and you've got to break a few things in order to get there. Now, do you want to send us into a deep recession or anything? No, you don't. But right now, there's nothing in the data that says we're going to have a deep recession at this stage. Now, it doesn't mean it can't change. Doesn't mean I'm not looking for that change. But as of right now, there's nothing out there that's sitting that. So for me, the Fed is making the right call. They're continuing to stick to the plan that is working, and it's not breaking things underneath yet. I think real estate is kind of that first thing that's really going to break. And I'll be honest with you guys, in terms of real estate here, one, it's not natural to have 25% increase in home prices year over year for 2 or 3 years straight. It's not natural. It's not right. Normally it's what, 3 to 5%? You're getting 25% one year, 25% the next year. Guess what? Prices probably need to come down. Home sales need to slow, a lot of other things like that. Commercial real estate, absolutely, but I haven't been buying, I buy some commercial real estate. I haven't been even looking at office buildings or malls or anything else like that for years because they've been declining for decades. The trend to work from home or partially work from home or less time in the office or, a lot of other variables like that has been going on for more than a decade now. This is not new. Actually, it's almost 20 years for some of those asset classes. It's not new. Did everything kind of get accelerated these past 3 years? Yeah, it absolutely did. Do a lot of these banks that hold a lot of that debt, are they going to be in trouble? Yeah, they are. And guess what? Doesn't matter whether the rates are 4% or 2% or whatever the heck the number is. They're in trouble because at some point in time, these office buildings are going to sit empty and these guys are going to default on these loans. Now, maybe it accelerates it because the loan rates are higher. I would agree there. It might accelerate the process, but it's happening regardless. So the interest rates, would you rather them help inflation or allow these bad office buildings that were bad investments to just stay alive a few years longer? That's what you're asking for. That's what these guys coming on TV and they own. I'm the asset manager of this REIT, and all I own is office buildings and malls. Guess what? You're in deep doo-doo, buddy, and your job's probably going to come to end a lot faster. Obviously, he wants it to not end so he can continue to kick that can down the road as long as possible. So of course he's going to come on and say the Fed is screwing this up. It's in his best interest in terms of his job and his paycheck to say that. In regards to inevitable conclusion, inevitably that's what's going to happen anyways in the end. It's just being accelerated because the interest rates are going up. So you tell me, if you'd rather have high inflation, but let this guy keep his job for a few more years because he's in a bad asset class, then go right on ahead. Let's ask for the Fed to move down. Okay, so on to CPI here. I'm sorry for the rant. Matter of fact, I'm totally off base here. I think with CPI, it's obviously going to continue to go down. Now, if for whatever reason the data comes in hot, expect a huge sell-off there because that would definitely embolden the Fed to continue to raise rates a lot more aggressive. Like we might see that 0.5 next time around instead of a quarter point or a pause the next time around. So I don't think that's likely. I think that's the least likely scenario, but that could absolutely happen. I definitely think we see it inflect down. Do we get a full percentage point down? I don't think so. I think the comps get better come more the summertime, June, July timeframe in terms of having easier year over year comps to where you could see big moves down. But I absolutely expect another large move down in regards to that CPI data, which we saw a big move down last time too. So I don't think we're going to get the same crazy reaction unless it's a huge, like if it's a full point down, I think at that stage, the market's absolutely going to rally. It's absolutely going to put real pressure on the Fed to at least come out and say they're going to pause. And I absolutely think we see a rally from there. But barring something like that, I think we continue to kind of trade in this band that we've been trading in since the run up at the beginning of the year here. And we continue to see that be the trend. And basically earnings will continue to be the story. And that's exactly what I'm watching. For me, I'm just continuing to execute my plan, guys. If I could talk, the word is execute. Execute my plan. You know what? Hey, SoFi, very good earnings. A couple minor concerning things, but basically they're caught up in the mess of all the banking crisis and everything else right now. So they got beat up. So I took advantage of it. Hey, great. You know, I don't remember what I bought at 470 something. Awesome. You had 3 or 4 days there if you went through the earnings and combed through it to add more shares. They're continuing to perform. We'll see. Long way to go. It's still, you know, I'm telling you guys right now, it's still clearly in that speculative category. I don't expect to go 25 next year or anything crazy like that. However, they're continuing to execute and get better, and the numbers are getting better. Everything is getting better, so I continue to buy. So I'm continuing to pay attention to earnings. Apple, great earnings. Surprised me. I actually didn't think we were going to get that good of earnings this time around. It was once again excellent earnings, but it's overvalued, so I'm not buying that stock. Even though I love that stock and I love the performance, I'm not buying that stock right now because it's clearly in an overvalued territory. Just follow your plan. Decide what's going to happen. I don't care what CPI release is, honestly. I care about how the market's going to react in regards to my stocks. And then obviously, which ones are on discount, which ones aren't. It's going to take a long time for Apple to be on discount again for me to add shares to that. However, it may mean some other stocks, like maybe Tesla dips down to a point where I want to make a play on that one again and start building out that position even more. Actually, it's already built out, but start adding my bonus shares on it. But all I know is be prepared, follow your plan, and be ready to take advantage if the market gets wild. Remember, if you want to see my watch list in real time, you want to see all my buy and sell alerts in real time, you want to see basically everything that I do, be able to talk to me, slide into my DMs, jump on the Q&As, learn a whole bunch, take 5 free courses and a ton more. Make sure you check out the pinned comment down there and see if the membership's right for you, because honestly, if Tesla does go on a run, if that CPI number is hot, it's going to push that price up. And honestly, I'm going to have to end the sale at that stage. So make sure you check that out and click this video here if you want to see exactly what I'm buying in this market, and click here if you want to see my exact plan for this market. So thanks for watching, and we'll see you in the next one.